What if you woke up tomorrow morning, checked your wallet, and saw 3.125 Bitcoin sitting there, worth over $300,000, deposited overnight from a machine humming in your basement? No exchange, no trading, just your hardware, the Bitcoin network, and pure luck. That fantasy is what keeps solo mining alive in 2026. But here's what nobody in the clickbait thumbnails tells you. The math behind that dream is brutal. Today we're going to go through all of it. The real odds, the real costs, the hardware, the electricity, and exactly what type of person solo mining actually makes sense for. No hype, just the honest breakdown. Let's start with what solo mining actually is, because a lot of people misunderstand it. When you mine Bitcoin, you're running a machine that does one job. Take a block of transaction data, run it through the SHA-256 hashing algorithm millions of billions of times per second, and try to find an output hash that meets the network's difficulty target. The first miner on the entire planet to find that hash wins the block and collects the reward. Right now, that's 3.125 Bitcoin per block plus transaction fees. A new block gets found roughly every 10 minutes. Here's the thing. You're not competing against a few other people. You are competing against the entire global Bitcoin mining network, which, as of May 2026, is running at approximately 980 exahashes per second. That's 980 million terahashes every single second. Your single Antminer sitting in your basement does 270 terahashes per second on a good day. So you're not just buying a lottery ticket. You're buying one ticket out of a pool of about 3.6 million tickets that gets redrawn every single day. That's solo mining. It is a lottery. It is not a business. It is not a regular income stream. The hardware is the buy-in, and electricity is the ticket cost you pay every day, whether you win or not. Let me explain how it technically works so you understand what's actually happening inside that machine. Bitcoin's consensus mechanism, proof of work, requires miners to repeatedly hash a block header, which includes transaction data, a timestamp, the previous block's hash, and a number called the nonce. The nonce is what miners change on every attempt. Your ASIC, application-specific integrated circuit, is doing nothing but incrementing that nonce and checking the output, billions of times per second. If the output hash is below the current difficulty target, you found a valid block. In the early days, you could do this on a CPU, then a GPU. But SHA-256 is so computationally simple and so parallelizable that purpose-built ASICs now run circles around even the best GPUs. We're talking efficiency differences of 100x or more. That's why GPU mining on Bitcoin has been dead for over a decade. Today, it's ASICs or nothing. When you find a block solo, you broadcast it to the network, nodes verify it, and the block reward, 3.125 BTC right now, goes directly to your wallet address. No middleman, no pool taking a cut. The full reward, yours. That's the dream. Pool mining works differently. You point your machine at a shared pool, contribute your hash rate, and get paid proportionally for every share you submit, a tiny fraction of a Bitcoin every day, like a paycheck. The pool finds blocks regularly because it aggregates millions of terahashes from thousands of miners. You get your cut. Predictable, boring, but mathematically sound. Now let's do the real math, because this is where most YouTube videos either gloss over the numbers or make them sound better than they are. The Antminer S21 XP, the current benchmark machine, runs at 270 terahashes per second. It draws 3,645 watts and has an efficiency rating of 13.5 joules per terahash. On the used market, you're looking at roughly $4,500 to $6,000 depending on condition and seller. That's your flagship option. The Antminer S21 Standard, not the XP, runs at 200 terahashes per second, and you can find them used for $2,000 to $3,000. Less hash rate, a bit less efficient, but a lower entry point. For someone just wanting to try this, the S21 Standard is the more reasonable bet.
Here's the thing about efficiency that most people skip over. Joules per terahash is everything. It tells you how much electricity you burn to produce 1 terahash of work. The S21XP at 13.5 joules per terahash is among the best available right now. An older machine running 25 or 30 joules per terahash burns nearly twice the power for the same output, which means at any given electricity rate, it earns less and costs more. If you're choosing between hardware, always run the J per TH number first. On the physical setup side, this machine is not a desktop computer. It draws 3,645 watts at full load. For context, a typical U.S. household circuit is 15 amps at 120 volts, which gives you about 1,800 watts. You need a dedicated 240-volt circuit with at least a 20-amp breaker, ideally 30 amps for headroom. If you've got HVAC background, you already know what a 3.6 kilowatt continuous load means for a room's thermal budget. This machine dumps serious heat, and in an enclosed space, you will need airflow management. A garage with a vent or a basement with a dedicated exhaust path is the realistic home setup. Noise is another factor. These machines run at around 75 decibels. That's louder than a vacuum cleaner, running 24 hours a day. Your living room is not the place for this. Electricity cost is not just important, it is the entire business model. At the end of the day, Bitcoin mining is the business of converting electricity into Bitcoin, and whether that conversion is profitable depends entirely on your kilowatt-hour rate. Let's run 3 scenarios with the S21XP at 3,645 watts. At $0.07 per kilowatt-hour, which is what you'd pay in low-cost regions like parts of Texas, Kentucky, or if you're running off cheap industrial power, your daily electricity cost is about $6.13. At current Bitcoin prices and network difficulty, pool mining with this machine nets roughly $3.75 per day, about $112 a month, $1,369 over a full year. That's positive. Not exciting, but positive. At $0.10 per kilowatt-hour, call it the break-even threshold for S21 class hardware, you're right at the margin. Some days you're slightly positive, some days slightly negative, depending on Bitcoin's price and network difficulty swings. This is survival territory. At $0.12 per kilowatt-hour, the U.S. residential average, you're running at a loss on pool mining. The machine makes less revenue than it costs to run. At $0.16 per kilowatt-hour, which is what many people in the Northeast or California actually pay, the math is deeply negative. You're paying more in electricity to produce Bitcoin than the Bitcoin is worth at the pool payout rate. This is where solo mining reframes the calculus, and it's an important conceptual shift. If you're pool mining at $0.12 per kilowatt-hour, you lose money predictably every day in small amounts. If you're solo mining at $0.12 per kilowatt-hour, you're also losing money, but you're losing it in exchange for a non-zero chance at 3.125 Bitcoin. You're not calculating expected daily return. You're buying a lottery ticket with a known daily ticket price. Some people find that a completely rational trade. The daily cost is capped, the upside is asymmetric, and you know exactly what you're paying for exposure to that upside. That's a different product than pool mining, and it's worth being honest about that distinction.
Let's put pool mining and solo mining side by side in plain terms, because the right choice genuinely depends on who you are. Pool mining gives you steady, predictable, small payouts. If you have cheap power, under $0.08 per kilowatt hour, pool mining is a real income-generating activity, not just a hobby. Your expected value is positive, variance is low, and you can model your returns like any other yield-generating asset. For miners with access to cheap power in industrial setups or specific utility zones, pool mining makes business sense. You take your cut of every block the pool finds, proportional to your contribution. It's boring, it works, and the math is on your side. Solo mining via CK Pool is a different animal. CK Pool charges zero fees. You point your machine at their server, they help you connect to the network, and if your machine finds a block, the full 3.125 Bitcoin goes directly to your wallet. The catch is obvious. Your odds are 1 in 3.6 million per day with a 270 terahash per second machine. You could run for years and get nothing. CK Pool publishes the blocks found by its users, and if you scroll through the history, you'll see small miners winning, 100 terahash per second, 200 terahash per second, occasionally less. It happens. but it happens the way winning the lottery happens. Real, but not something you can plan around financially. The person who should pool mine. Anyone with cheap power who wants to treat this as a productive asset, anyone who needs predictable cash flow from their hardware, anyone who can't stomach watching electricity bills accumulate with zero payout. Pool mining is the rational choice for almost everyone under almost any financial framework. The person who solo mining actually makes sense for. Hobbyists who have cheap power and find the project inherently interesting. Someone who wants to run a node, learn the protocol, and has a if it hits, it hits mindset. People in situations where they have access to below-market electricity. Think someone who owns a business with surplus power, someone with a specific utility arrangement, or someone running off a renewable source. People who have genuinely done the math, understand they are EV negative at typical US power rates, and are consciously choosing the lottery structure for the asymmetric upside. If you understand what you're buying, solo mining is a legitimate choice. If you're doing it because you think you'll make money steadily, you will be disappointed. So here's the honest verdict on solo Bitcoin mining in 2026. The fantasy is real. 3.125 Bitcoin, over $300,000 found by your machine in your basement. The math is also real. 34,000 years expected with a single S21 XP running solo. Both of those things are true simultaneously, and how you feel about that tension determines whether solo mining is right for you. If you want to try solo mining, CKPool is the place to go. ckpool.org, 0 fees, you keep the full reward. If you want steady returns and have access to power under $0.08 per kilowatt hour, point your machine at a reputable pool and let it work. If you're on U.S. residential rates above $0.12 per kilowatt hour, run the electricity math before you buy anything. The hardware economics are tight, and the break-even on the machine itself is a long road. In the next video, we're going to go deeper on pool selection, how to evaluate fees, payout structures, and whether FPPS, PPS Plus, or PPLNS is actually the right model for your setup. That one's worth watching before you configure anything. If this breakdown was useful, subscribe. We keep it data-driven, no hype, same as always. See you in the next one.